Imagine this, you're 50 years old, you've built a solid life, paid off most of your debt, put your children through university without loans, and steadily you've grown your savings. You and your spouse are both still working and earning well. Your goal? Retire at age 60 with the income of about 100,000 Rand per month in today's terms. But then it hits you, you're running out of time. You're entering the pre-retirement phase, and every financial decision from here on carries more weight than ever before. Then you start asking the big questions. Are we saving and investing enough and in the right vehicles? Will our money last 30 plus years into retirement? What's the most tax-efficient way to grow our wealth over the next decade? How should we draw income once we stop working? Should we be investing more offshore or more locally? And if something happens to one of us, will the other one still be financially secure? In this video, we'll unpack these questions using real-world case study. A South African couple with 10 million Rand in retirement savings, offshore assets, properties, and a strong earning potential. We'll walk through strategies to help them and you retire confidently, minimize taxes, avoid the common mistakes, and design a flexible plan that adapts to life's changing circumstances. Because retirement planning is about more than just numbers. It's about building freedom to retire on your own terms. Hi everyone, and welcome back to the Family Wealth YouTube channel. I'm Hardy Swart, a certified financial planning professional and a director at Family Wealth Custodians. If you're new here, we're here to help South Africans make better financial decisions through honest, practical, and real-world financial planning insights. Our mission? To empower over 1 million South Africans to retire with confidence. If you find this video helpful, hit the subscribe button, turn on the notifications, and share it with someone who could benefit from it. You never know who's quietly worrying about their retirement behind the scenes. And before we dive in, just a quick disclaimer. This is a case study based on real-world scenarios, but it's for educational purposes only, and it doesn't constitute personal advice. Always speak to a qualified planner before making any big decisions. So, without further ado, let's dive in. Let's start by setting the scene for today's discussion. We're looking at a couple from Pretoria. Let's call them Andre and Susan. They're both 50 years old, and over the past couple of years, they've made a series of smart financial decisions. Andre is a qualified engineer, and recently he was offered an opportunity to work for an offshore mining company. Thanks to his experience and global demand for his skill set, they offered him a salary of about $200,000 per year before tax. This wasn't an easy decision to make. The job demands long hours and requires him to be away from home for more than 200 days each year. But after many late-night conversations, weighing the impact on family, health, and their future, Andre and Susan decided that it was the right thing to do. A final 10-year push to secure their dream retirement. Susan, on the other hand, runs a successful accounting practice in South Africa. She earns around 1.2 million Rand per year before tax, and she has a steady hand at home, keeping things grounded while Andre is working abroad. So if we look at Andre and Susan's combined retirement savings, we can see the following. They have approximately 10 million Rand in assets and retirement savings that consists of the following. So first, if we look at Andre's side, we can see that he's got a pension preservation fund of approximately 3.5 million Rand. Furthermore, he's got an offshore bank account of about $110,000, which, depending on the prevailing exchange rate, is approximately 2 million Rand. And then if we look at the income he's earning, on his offshore bank account, he's earning approximately 60,000 Rand a year or 3% in interest. And then he also earns a salary of approximately $200,000 a year, which equates to, let's say, about 3.6 million Rands a year before tax. Now, if we look at their joint estate, we can see that they've got their primary residence, which is valued at about 6 million Rand. This is also situated in Pretoria and quite a safe neighborhood. The important factor to consider is that their primary home or their primary residence is the home that they live in. And this is a lifestyle asset. It's not an investment asset. And we must always distinguish between lifestyle assets and investment assets. Now, if we move on to Susan's side, we can see that she's got a flat on her name. This is a student flat in Stellenbosch worth approximately 2 million rand. They've made the final payment on the bond, so there's no more debt on that flat. And then she also has a fixed deposit account sitting with a South African bank of about 1 million rand, and she's got a retirement annuity with one of the big insurance companies in South Africa of about 2.5 million rand. Then if you look at the income that Susan is earning, on the flat, she's earning an annual rental income of about 180,000 rand per year, and on her fixed deposit account, she's earning approximately 7% or 70,000 rand a year in interest, and then from her accounting business, she draws a salary of approximately 1.2 million rand a year. They've raised their children, put them through university without debt, and the kids are now financially independent. Now, with just 10 years to go until retirement, Andre and Susan are asking the big question: are we on track to retire at 60 with 100,000 rand per month in today's money? And how do we make the most of the next decade to secure our financial future? That's exactly what we'll explore in this video today, step by step. That brings us to the 7 big questions that could potentially transform your retirement. First, how much income do you actually need to fund your retirement, the retirement you envision? Next, how much capital do you need, adjusted for inflation, to support your dream lifestyle for the rest of your life? Third, what investment strategy can get you there over the next 10 years while balancing growth and risk? Fourth, what are the most cost and tax efficient ways to invest, both locally and offshore? And then fifth, when you retire, how should you structure your income, from annuities to rental income to offshore withdrawals? And then we also look at what risks can disrupt your plan and how can you protect yourself from life's unexpected turns. And finally, does working with a professional advisor actually move the needle, and how? In this video, we'll be applying these questions to the case study of Andre and Susan. So let's dive in. So the first question we need to answer is, how much income do Andre and Susan need at retirement? Before we jump into the numbers, we need to ask, why do Andre and Susan want 100,000 rand per month in retirement? Where did that number come from? Have you ever asked yourself the question, how much income would you like to earn in retirement? And how much money would you need to actually fund your income in retirement? I'd love to read your answers, so please send your answers in the comments below. At Family Wealth Custodians, we don't use generic rules or the rules of thumb. Instead, we follow a dynamic retirement income plan, a tailored approach that helps clients spend with confidence while safeguarding long-term financial security. This approach recognizes that spending patterns evolve over time. So instead of assuming a flat monthly income, we break retirement into 3 distinct phases. The first phase of retirement we call the go-go years. These are the first 10 to 15 years of retirement, when retirees are healthy, energetic, and eager to enjoy life. Spending in this period tends to be the highest. This phase often focuses on travel, hobbies, dining out, and other leisure activities. The next phase of retirement we call the slow-go phase. During this period, which typically spans the next 8 to 10 years, activity levels begin to decline. Spending decreases as retirees travel less and prioritize simpler pleasures, but occasionally leisure activities remain part of life. Then the final part of retirement we call the no-go or quiet years. This is the final phase of retirement, where spending is primarily focused on essentials like healthcare and daily living expenses. Discretionary spending in this period is minimal, and healthcare costs often become the biggest portion of your total expenses. So, how do we calculate their required income? Well, we take a bottom-up approach, starting with the essential first, and then layering stuff like lifestyle choices and others. Here's how we guide clients like Andre and Susan. The first step is to budget for healthcare first. Healthcare is the foundation of any retirement plan, given the importance and rapid cost escalation. Why is it critical? Medical aid premiums and healthcare expenses typically increase by 10 to 12% annually, far outpacing general inflation in South Africa. Our approach is we allocate a portion of the budget for medical aid, gap cover, and anticipated out-of-pocket expenses. We factor in future healthcare needs such as long-term care, chronic illness, particularly for the later years of retirement. Planning for medical expenses first ensures that retirees have access to quality care throughout their lifetimes. So if we look at Andre and Susan's situation, we know that Andre said that he wants to budget about 20,000 Rand per month for medical expenses. The reason for this is that he's got a chronic condition that he needs to take care of. Furthermore, they've got the top medical aid in South Africa. So if they start with, let's say, 20,000 Rand per month, and we include an inflation or medical inflation of about 12%, we can see that over time, the cost of medicine and medical aid and healthcare in their overall budget is going to be astronomical. Step 2 of this process is to cover basic living expenses. So we look at the essentials needed to maintain a desired lifestyle. Here we look at costs such as housing, utilities, groceries, transportation, and insurance premium. We use a general inflation rate sitting at approximately 6%. This ensures that your expenses keep pace with rising costs. Our approach is to assess current and living costs and to adjust for any changes in retirement, such as downsizing or relocating. This builds a baseline budget that guarantees financial stability and covers all the necessary expenses. In Andre and Susan's budget analysis, it showed that their monthly living expenses is approximately 40,000 Rand per month. So we can see if we add that on top of medical inflation, we've got a solid foundation of what the base of their budget would look like. The third step is for us to add discretionary and lifestyle spending. Once the basics are covered, we plan for the fun stuff. What's included are stuff like travel, hobbies, dining out, and gifts. Andre and Susan's dream is to extensively travel the world and maximize the first 10 years after retirement. Therefore, they seek an additional funds of about 40,000 Rand per month for the first 10 years, followed by approximately 20,000 Rand per month for the following 10 years. Now, of course, this is in today's terms, and we need to take into consideration inflation of about 6% on these sort of expenses. For this example, we assume they both live until the ripe age of 95. Their monthly income needs in today's terms, inflation adjusted, looks as follows. So for the first period, which we call the go-go years, they're going to need approximately 100,000 Rand per month. This includes their medical expenses, living expenses, and their discretionary spending. Then, for the following period, which we call the slow-go years, their discretionary spending slightly decreases in today's terms, but they still have to cover their medical expenses and living expenses. And then the final period of retirement, what we call the no-go years, there they've budgeted for approximately 60,000 Rand per month in today's terms. But we have to consider the fact that medical inflation sits at 12%. So if we look at the spending pattern, we can see for the final stretch until end of life, medical expenses forms the biggest part of their overall budget, where in the beginning phase it might constitute about 20% of their monthly budget. At the end or the later stage of life, it can constitute 60 to 70 to 80% of their monthly budget. So why does this approach work? This approach is by no means a perfect science, but it provides a clear framework that can be adjusted as circumstances change. Furthermore, it's tailored to your unique life stage. The dynamic income plan aligns with the natural rhythm of retirement, adapting as priorities and needs change. Furthermore, it provides for sustainable budgeting. By focusing on essentials first and adjusting discretionary spending, retirees can avoid the risk of running out of funds. And it's inflation-proof. Using realistic inflation rates, it ensures that retirees maintain the purchasing power over time. It also provides peace of mind. This structured approach provides confidence that your retirement savings will support you throughout your lifetime. By starting with the dynamic income plan and breaking it into actionable steps, we help retirees enjoy their money during the vibrant years while safeguarding their financial security for the quieter years ahead. When it comes to retirement planning, there's no universal solution. Each individual has unique goals, aspirations, and concerns. What may be a substantial amount of money for one person might not be the same for the next. This brings us to the next big question. How much capital you need, adjusted for inflation, to support your dream lifestyle for life? Now that we've determined how much income Andre and Susan would need, the next step is to figure out how much capital they need to generate this income. One popular starting point is the 4% rule, a classic guideline in retirement planning. This rule was developed by William Benjamin, a Californian financial planner in the late 1990s. The rule suggests that when you withdraw 4% of your retirement savings in the first year and you adjust that amount for inflation every year thereafter, if your portfolio is well diversified, equally split between bonds and shares, your money should last at least 30 years. If you'd like to find out more about this rule and other ways to determine your retirement number, we've made a dedicated video calculating your retirement number and understanding the 4% rule. The link for that video is in the description below. So, how do we apply the 4% rule to Andre and Susan's situation? Oftentimes, clients would come to us and with the question, how can they determine how much capital they need at retirement? Or they want us just to give them a ballpark figure. Well, you can actually use the 4% rule to determine more or less how much you would need. So if we take their situation and we look at the fact that they want to retire in 10 years with an income of about 100,000 Rand per month in today's rands, that means that they'll need about 1.2 million Rand annually. So if we take this forward 10 years into the future at an inflation rate of 6%, that means that they're going to need approximately 2,149,000 Rand at retirement. So by using the 4% rule, we can calculate how much capital they'll need more or less. So what we can do is we can divide the 2,149,000 Rand that they're going to need in 10 years' time, divided by 4% or 0.04, and this gives us a more or less a capital amount that they'll need. So if they retire in 10 years, the future value of this amount would be approximately 53,725,425 Rand that they'll need at retirement. If we bring it back to today's terms, they're going to need approximately 30.6 million Rand to achieve their dream retirement. But here's the catch. The 4% rule has its limitations. While it is useful as a guideline, it was created for US retirees, and South Africans face some unique challenges. The first flaw is that people are living longer. The rule assumes a 30-year retirement, but with better healthcare, many South Africans could live well into their 90s, which means your savings needs to last longer. The second flaw is what we call sequence of returns risk. If markets perform poorly in your first few years after retirement, and you're also drawing an income at the same time, your portfolio could suffer a double hit. Even if markets do recover later on, you might not have enough capital left to benefit from that. The third flaw is that South African inflation is much higher, especially when it comes to things like healthcare inflation, which often exceeds 10 to 12% annually, making real returns harder to achieve. The fourth flaw is the fact that it's based on US market data. The original study was conducted in the US using US stock market and bond returns, which have historically outperformed those in South Africa. Local investors might not get the same sort of outcomes. The fifth flaw is the fact that spending isn't flat. Real life doesn't follow a neat 4% line. People tend to spend more in their 60s and 70s and less later on, until healthcare costs start to rise again. Final thought, it's a guideline and not a rule. The 4% rule serves as an excellent starting point, but retirement planning is not a one-size-fits-all. Let's run the real numbers. Let's go deeper and model Andre and Susan's actual income needs, including different inflation assumptions and investment returns. So let's quickly do a recap of the assumptions we use in our calculation. So first, if we look at medical expenses, what's important to note here is that we're planning for about 20,000 Rand per month, which equates to about 240,000 Rand per year, and we're planning for a term of from the age of 60 until the age of approximately 95. But what's important is that the inflation rate we're working with here is sitting at 12%. The next thing we'll look at planning for is basic living expenses. So here we're looking at a monthly number of about 40,000 Rand, and this equates to about 480,000 Rand annually. What's important to note here is that we are also planning here for a period from the age of 60 until the age of 95, which is our budgeting period, and also which we say will be the end of life. And here we're working with an inflation rate of about 6%. Then, if we look at the go-go years and the slow-go years, but specifically the go-go years, we're working with a 40,000 Rand per month for the first 10 years of retirement. So that's about 480,000 Rand a year, and we're working with an inflation rate of also 6%. And then for the next 10 years or 10 years after retirement, we're looking at the slow go years where discretionary spending slightly decreases. Here we're looking at 20,000 Rand per month or about 240,000 Rand a year, and we're planning until the age of 80 and working with an inflation rate of 6%. All right, so now if we look at this in context, if we put the numbers into our financial planning software, we now know that for the go-go years, we're planning of 400,000 Rand per month. For the slow-go years, we're planning for 80,000 Rand per month. And for the final phase, or the no-go years, we're planning for 60,000 Rand per month. Of course, all of these amounts are adjusted for medical inflation and normal inflation. So when we project these numbers into 3 different growth scenarios, we will see the following. So we created 3 different scenarios. The first one is what we call a moderate growth scenario, where we're sitting on net return on their capital for approximately 8%. The second scenario, we used the moderate aggressive growth scenario, where the return is sitting about 10%. And the last one is an aggressive scenario, where we're looking at returns of about 12%. Remember, these are assumptions, but we're not only planning for the next 10 years until they retire, we're also looking at the 30 years after retirement, which is quite important. So coming back to the example, if we look at an 8% net return on their capital, then they're going to require approximately 39 million Rand in today's terms to be able to retire comfortably. That means they're only about 26% funded as it currently stands. And the next one, looking at a return of about 10%, they're going to require approximately 24 million Rand to draw the same amount of income. And that means they're about 38% funded, meaning there's still a massive shortfall. And then in the last scenario, if they get a 12% return on their capital, then they only require 15 million to maintain the same level of income in retirement. And that means they will be 55% funded as it currently stands. So as you can see, is what is super important is the more growth you get in your portfolio, the lower the amount of capital you're going to need at retirement, which makes sense. But what is very important to consider is the fact that in order to generate more growth on your portfolio, you would need to take more risk. And more risk also comes with the concept that you might lose money as well. So you have to take that into consideration as well. Now that we know how much capital Andre and Susan would need at retirement and how far they still need to go, the next big question is, what investment strategy gives them the best chance of reaching their retirement goal without taking unnecessary risk? At Family Wealth Custodians, our starting point is always the same: asset allocation, because how you divide your money across different asset classes is one of the biggest drivers of long-term investment returns. But then the question arises, how do we determine what is the optimal asset allocation for a specific person? We start by determining each investor's unique risk profile. This is done through a combination of psychometric testing and a financial capacity analysis to assess both emotional risk tolerance and the practical ability to take risk. The reality is that human emotions often drive decisions, influenced by external factors that are not necessarily logical. It has been observed time and time again that when markets go up, people feel a sense of euphoria and everybody starts buying. And that's most of the time the worst time to buy, because you buy at the peak of when the markets are at its highest, and then markets start declining, then you're actually losing money. And the inverse of that is when markets start falling, there's a point where investors start panicking and then they just sell without really thinking about why they're selling. And when they sell at the lowest points, they're actually realizing their losses. So there's definitely a balance between how you look at the markets and not being over emotional when you're looking at investments. Risk and return go hand in hand, and your asset allocation will have a direct impact on your retirement outcome. That's why it's so important to get it right early and to revisit it regularly. Asset allocation will help you smooth out the ups and the downs, making it more bearable so when there's a massive volatility in the market. Coming back to Andre and Susan, so we helped them determine their risk profile, and what we found is that they were both moderate aggressive investors. This means that they are comfortable with taking on some market volatility in the pursuit of higher long-term returns. They still want a degree of capital preservation, but they know they'll need exposure to growth assets like equities and offshore investments in order for them to reach their ambitious goals. So if we look at an example of what a moderate aggressive person's asset allocation would look like, it would look something similar to this. Now again, this is not an exact science, because every person is unique, but just to give a broad idea of what it would look like. First, if we look at the exposure to growth assets, which is equity and property, we can see that we'll sit at approximately 70%, 69 to 70% in equity and property exposure, and bonds will sit at approximately 18 to 20% exposure. And then there'll also be some exposure to maybe hedged equities or alternative assets, and there might also be some cash exposure. But the important thing is when you look at asset allocation is the fact that South Africa only constitutes about 1% of the global economy. So for us, there's a lot of opportunities that we cannot get in South Africa. Thus, we have to look at investing offshore. Not only that, by investing offshore, we also hedge ourselves against the volatility of the rand and our own political instability in South Africa. So for their specific scenario, what I would recommend is looking to invest about 40 to 50% of their portfolio in South Africa, and about, let's say, 50 to 60%, maybe a bit more, depending on their needs, directly offshore. So for Andre and Susan, this allocation aims to outpace inflation while managing downside risk. This is ideal for them because they've got a 10-year plus time horizon. So they are able to take on more equity risk and more growth assets into their portfolio in order to reach their goals. Now, let's look at the path forward for Andre and Susan. And how do we realign their portfolio to give themselves the best shot of retiring comfortably? Andre and Susan would need to start by first gradually shifting away from their capital, away from cash and low-yielding instruments into growth assets. Secondly, they would need to increase their offshore exposure by using tax-efficient structures and investment platforms. Third, they would need to diversify across equities, bonds, alternatives, and other currencies. And they would need to implement a rebalancing strategy to stay on track over time. Fifth, they need to avoid market timing. Focus on time in the market rather than trying to guess the highs and the lows of the market. The key takeaways for Andre and Susan are that they don't need to take unnecessary extreme risks, but they do need to take smart, intentional ones. By following a globally diversified, moderate aggressive investment strategy and staying disciplined over the next 10 years and longer, they can close the gap between their current 10 million rand and the capital they need or the target they need to retire comfortably. This takes us to the next question. What's the most cost and tax efficient way for them to save and invest both locally and offshore? Now that Andre and Susan have a solid investment strategy in place, they need to take the next step. And they need to ask themselves, how can they invest more effectively while keeping costs low and taxes under control? This part of the plan can make or break their retirement outcome. The first thing they need to look at is reducing unnecessary investment costs. At Family Wealth Custodians, what we do is we use linked investment service providers, what we also call LISPs, companies such as Allan Gray, 91, and a couple of others. Why? Because these platforms offer clients access to both local and offshore investments in one centralized place. It offers lower fees than traditional insurance platforms and greater transparency and flexibility. It also provides the ability to pool family members or trust together for reduced pricing. By conducting a platform comparison, we can determine if Andre and Susan are overpaying for their current solutions. Where we can reduce annual fees by consolidating their portfolios and switching to lower cost, high quality funds, we will do that. For example, let's say they can save 1% of total costs over a year. On their 10 million rand portfolio, that equates to 100,000 rand a year back in their pockets just by saving in costs and fees. Next, we're going to look at smart tax planning. Taxes are unavoidable, but how much you pay and when you pay it can be influenced by smart financial planning. When it comes to saving for retirement, being tax efficient isn't just a nice to have, it's an absolute game changer. Here's why. Every rand you save in taxes is rands that stay invested, compounding and growing for your future. Over time, these tax savings can make the difference between retiring comfortably or running out of money too soon. In South Africa, our income tax system is progressive, meaning the more you earn, the higher the percentage of tax you're going to pay on each additional portion of income within a specific bracket. Here's how it works. Income is divided into different brackets, each taxed at a different rate. The marginal tax rate is the rate applied to the highest portion of income. The example of Andre and Susan can be used to illustrate their current tax position and identify ways to optimize their savings in a tax-efficient manner. Andre is beginning employment at an offshore mining company, earning approximately $200,000 per year before tax. This job requires 200 days and more than 60 consecutive days away from home annually. Section 10102 of the South African Income Tax stipulates that residents must meet the 183 days or 60 full days criteria for tax exemption. The first 1.25 million rand of foreign employment is then exempt from income tax, but any amount above this will be taxed according to the normal standards tax tables as of 1 March 2020. I must say it is advisable to consult with a tax professional if you are earning foreign income to make sure that you comply with all the necessary tax legislation. You don't want to mess with SARS. Let's look at the tax calculation of Andre and Susan's position. Like we mentioned, Andre is earning $200,000 per year. So let's say that is approximately 3.6 million rands currently. Furthermore, he gets interest exemption of about 1,250,000. That means his taxable income is about 2,350,000 rand a year. Then we have to take into consideration the interest he earns. He's currently earning about 60,000 rand interest on his offshore investment or the offshore bank account, on which he gets the annual interest exemption of 23,800 rand. That means the taxable portion of his interest is about 36,200 rand a year. That brings his total taxable income to approximately 2.3 million rand a year that he's going to pay. That means the tax he's going to pay sits at about 883,000 rand annually in taxes. Now, if we look at Susan's situation, she earns 1.2 million rand a year from her accounting practice, and that she also earns the interest and rental income. So that means her total taxable income for the year is sitting at about 1.4 million rand, on which she's going to pay tax of about 457,000 rand. That means their combined tax position is they need to pay approximately 1,340,000 rand a year in taxes. Now that we've calculated Andre and Susan's current tax position, let's explore 4 tax-efficient strategies that they can use to maximize their retirement savings and minimize taxes. These strategies will not only help them reduce their current tax burden, but also grow their wealth in the most tax-efficient way for retirement. The first strategy we're going to explore is contributions to a retirement annuity. Over the years, I've seen many people who are skeptical about retirement annuities. This skepticism often stems from bad experiences with other older products about high fees and limited flexibilities. But here's the good news. The industry has come a long way. Modern RAs are now highly regulated, cost-effective, and offer access to world-class investment options tailored to your unique goals. Benefits of retirement annuities. Tax savings. Contributions are tax deductible up to 27.5% of your taxable income or remuneration, capped at 350,000 rand per year. For Andre and Susan, this means immediate tax relief. Furthermore, you're looking at tax-free growth. There's no tax on interest, dividends, or capital gains within an RA. This allows investments to grow faster over time. Diversification. RAs allows for exposure to a wide range of assets, including offshore investments within a Regulation 28 limit. If structured correctly and you pass away, there is no estate taxes or executors' fees payable on your retirement annuity. The drawbacks of retirement annuities are you've got limited access. The funds are locked in until the age of 55, and at retirement, 2/3 must be used to purchase an annuity. Furthermore, you are bound by Regulation 28. This limits exposure to riskier asset classes like equities and offshore investments. Next, there's tax on income. When you convert a retirement annuity to a life or living annuity, the income you draw is taxed at your marginal tax rate. After carefully evaluating their options, Andre and Susan decided to contribute the maximum allowable limit of 350,000 rand each annually. Their retirement annuity contribution not only reduces their taxable income significantly, but it also ensures that their money grows in a tax-free, cost-effective, and disciplined manner. Next, we will look at contributing to a tax-free savings account. A great tool I recommend to all my clients, even those with very large portfolios, is a tax-free savings account. TFSAs, as we call them, are one of the simplest and most effective ways to grow your wealth tax-free, regardless of your income level or portfolio size. With no tax on interest, dividends, or capital gains, this provides outstanding growth potential over the long term. The benefits of tax-free savings accounts are the fact that there's no tax on growth. Contributions of up to 36,000 Rand per year with a lifetime limit of 500,000 Rand allow all your returns, including interest, dividends, and capital gains, to grow completely tax-free. There also is the availability of flexible withdrawals. Funds can be withdrawn at any time without penalties, offering financial versatility to meet unexpected expenses or take advantage of opportunities while still benefiting from the tax-free growth. Diversification. Tax-free savings accounts allows investments in a wide range of instruments, such as unit trusts, ETFs, and money market funds. These products provide exposure to different asset classes, enabling a well-balanced and diversified portfolio tailored to your specific financial goals. The drawbacks of tax-free savings accounts are the fact that there are contribution limits. The annual cap of 36,000 Rand may feel restrictive for someone like Andre or Susan, who earns a high income and wants to invest more. There's a loss of contribution room. Any withdrawals permanently reduce the available lifetime limit, so withdrawing funds early could impact the long-term growth. After evaluating their options, Andre and Susan decided to contribute the full annual amount of 36,000 Rand each to a tax-free savings account. They see that this is a simple, cost-effective way to grow their savings tax-free while maintaining the flexibility to access funds if needed before retirement. Often clients, especially those with larger portfolios and high incomes, ask if contributing to a tax-free savings account really makes a difference. To answer that, I like to provide a simple example. If you contribute the maximum amount of 36,000 Rand per year for approximately 14 years, the time it would take to meet the lifetime limit of 500,000 Rand, and your tax-free savings account grows at 10% per year, then your account can grow to approximately 1.4 million by the end of the period. At retirement, this could provide an additional tax-free monthly income that you can withdraw without affecting your taxable income or pushing you into a higher bracket. The third strategy is over-contribution to a retirement annuity. This is also called disallowed contributions. One of the most powerful yet underutilized tax strategies, especially for high-income earners like Andre and Susan, is making additional contributions to your retirement annuity above the allowable annual tax deductible limit. These excess amounts are referred to as disallowed contributions. While they don't give you the immediate tax relief, they still offer significant long-term benefits, particularly when you start drawing income at retirement. So, what are the benefits of a disallowed contribution? First, we're looking at deferred tax advantage. Even though the overcontribution isn't tax deductible now, it's tracked by SARS and can be used later on to reduce taxable portion of your annual income, or you can draw a tax-free lump sum at retirement. It provides for tax-free growth. Regardless of whether your contribution is allowed or disallowed, the entire portion of your retirement annuity continues to grow free of tax on interest, dividends, and capital gains. Furthermore, it provides future tax-free withdrawals. At retirement, if the disallowed portion hasn't been utilized, Andre and Susan can withdraw it as part of their tax-free lump sum, or they can draw tax-free monthly income from their living annuity until the disallowed capital portion has been depleted. It also provides estate planning efficiency. Like regular retirement contributions, disallowed contributions are exempt from estate duty and executors' fees, making them a highly efficient form of planning for your legacy and to provide financial planning benefits to your loved ones. So, what are the drawbacks of a disallowed contribution? Well, first of all, there's no immediate tax relief. Disallowed contributions don't reduce your taxable income in the current year. The tax benefit only comes later during retirement. You're locked in until retirement. Like all retirement annuity contributions, the funds are preserved until the age of at least 55. Let's look at how Andre and Susan are using this strategy. After contributing their 350,000 deductible RA limit, Andre decided to invest an additional 240,000 Rand and Susan an additional 120,000 Rand a year into their respective retirement annuities. While these extra contributions don't reduce their taxable income today, they provide long-term tax-free investment growth and tax-free withdrawals later, either as lump sum or as a monthly income. Furthermore, it lowers future tax rates on annuity income, and it provides estate protection by avoiding executors' fees and estate duty. This is a strategic way to build wealth in a tax-sheltered environment and unlock tax benefit later in life, exactly when they're going to need it the most. The fourth strategy we're going to explore is investing into an offshore endowment or sinking fund. As Andre and Susan's earnings continue to exceed their allowable tax-deductible contributions, they need another tax-efficient way to invest the excess discretionary income, especially the offshore ones. One of the smartest strategies available to South African investors is the use of an offshore endowment or sinking fund invested in roll-up funds. These investment vehicles are structured to defer tax on growth while ensuring unique estate planning and income smoothing benefits. The benefits of investing in offshore endowments or sinking funds. First of all, you get the tax deferral benefit, especially when investing in roll-up structures. Unlike local unit trusts where you're taxed annually on interest, dividends, and capital gains, roll-up funds reinvest all these returns without triggering tax events. Tax is only paid when Andre and Susan access these funds, allowing for compounding without leakage. Capital gains tax is only taxed at 12%. Roll-up funds are designed to convert all income and growth into capital appreciation. When withdrawals are made, the entire gain is taxed as the capital gain at a flat 12% rate, which in your personal capacity could be much higher. For example, Andre's marginal tax rate is sitting at 45%. This means there's a significant tax saving for him to invest in such a structure. Furthermore, capital gains is calculated in dollars and not in rands. Thus, you don't need to pay unnecessary capital gains because of rand weakness. These structures also provide access to global investment options. Andre and Susan can invest in hard currency portfolios across a variety of sectors and asset classes, including global equities, fixed income infrastructure, and thematic funds like technology and healthcare. There's also estate planning benefits. Endowment policies allow for the nomination of beneficiaries, meaning that the proceeds can bypass their estate, avoiding executors' fees. It also ensures faster access to funds for loved ones. Furthermore, if beneficiary appointments was done correctly, then funds don't need to be repatriated back to South Africa, thus excluding forex-related costs and admin. Next, it also provides liquidity and a form of structured withdrawals. Although typically designed for medium to long-term investments or 5-year plus, partial withdrawals are allowed after the first 5 years. After this period, Andre and Susan can create a structured income stream or withdrawal ad hoc as they need it, without incurring any additional admin. The drawbacks to consider when investing into an endowment or sinking fund are that you have a 5-year restriction period. So during the first 5 years, withdrawals are restricted, although not completely locked in. This strategy is better suited for medium to long-term savings, not necessarily for short-term access. There is also no use of the annual CGT exclusions or tax loss harvesting because the gains are realized within the structure. Also, when investing into an offshore endowment or sinking fund, you're exposed to currency risk. Since these funds are offshore, they are exposed to exchange rate fluctuations. While this provides great diversification benefits, it also may cause short-term volatility when converting back to rands. So, how will Andre and Susan use this strategy? With their taxable income pushing them into the highest tax brackets, and with their RAs and tax-free savings accounts utilized, Andre and Susan can decide to invest into a roll-up offshore sinking fund or endowment and take advantage of global diversification and tax-efficient growth. Andre decides to invest 110,000 Rand or approximately 2 million Rand he already has offshore in a bank account in hard currency into his offshore endowment or sinking fund. In addition, he commits to investing about 1.5 million annually from his ongoing foreign earnings into the same structure. This allows them to tap into world-class investment portfolios denominated in dollars, pounds, or euros. It also defers tax on growth, and they will only pay 12% capital gains tax when they eventually withdraw from those portfolios. It creates tax-efficient offshore income streams in retirement, achieve estate planning advantages. As the endowment structure or sinking fund allows for nominated beneficiaries, bypassing executors' fees and delays. By using a roll-up offshore endowment or sinking fund, Andre and Susan are not just growing their wealth, they're creating a highly strategic offshore plan that complements their local investments and gives them flexibility and protection and peace of mind. Now, if we circle back to Andre and Susan's post-implementation tax position, especially now that we know exactly which vehicles they're going to use to give them the biggest tax benefit for their savings, we can have a look at what their current position looks like. Firstly, their income stays the same, but what does change is for both of them, the amount of interest they're going to earn is going to be a bit lower, and that will be pretty much excluded. So the 23,000 Rand, 800 Rand interest exclusion that they get, or exemption that they get, means that they're going to pay no tax on the interest. Furthermore, their retirement annuity contribution is going to be 350,000 Rand each. That means their taxable income becomes less with 350,000 Rand, which equates to a total tax for each of them. For Andre, it's going to be about 698,894 Rand, and for Susan, it's going to be 294,826 Rand. That means for them combined, from the first year onwards, there's going to be an approximate 347,000 Rands of tax saving in the first year and every year from there on. But this is only the immediate tax saving from the retirement annuity contribution and the restructuring of the portfolio. We also have to consider the fact that the vehicles they're going to save in now, there's not going to be any tax or much lower tax in the vehicles they're going to use. The retirement annuity contributions, tax-free savings contributions, and also the endowment, which is only taxed at 12%. So there's a definite tax benefit for them over the long term. This brings us to our next question that we have to address. And this is, how do they draw on income in retirement? Although it's still a long time till they get to retirement, more than 10 years, the big question they have is, if they get to retirement, how can they withdraw their income in the most tax beneficial way? From a combination of annuities, rental income, offshore withdrawal, and discretionary assets. Once Andre and Susan retire, the focus shifts from building wealth to spending it wisely. How and where they draw their income from will determine whether their money is going to last or is it going to run out too soon. Let's walk through how they can build flexible, tax-efficient retirement income plan using their available resources. So when it comes to drawing an income in retirement, the first question we need to ask is, are you going to withdraw a retirement fund lump sum? At retirement, post the age of 55, South Africans are allowed to withdraw 1/3 of their retirement fund as a lump sum, while the remaining 2/3 must be used to purchase an annuity. This lump sum is taxed according to the Retirement Fund Lump Sum Benefit Tax Table. For the 2026 tax year, the first 550,000 Rand, which is a lifetime cumulative, is tax-free depending on the previous withdrawals. The rest is taxed on a sliding scale. The key insight here is that if Andre and Susan have not previously used their tax-free withdrawal allowance, they can access this 550,000 Rand tax-free at retirement, which can be used for debt clearance, renovations, or reinvestment for retirement. The next thing we need to look at is living annuities and disallowed contributions. At retirement, Andre and Susan will convert the remaining 2/3 of the retirement annuity, pension fund, and pension preservation fund into a living annuity, as opposed to a life annuity. We did a dedicated video on how to decide between a living and a life annuity and the pros and cons of both. You can find the details of this video in the description below. So let's look at the tax on living annuity withdrawals. Income from a living annuity is taxed as ordinary income. Retirees often make the mistake of drawing their entire income from there. However, this is unnecessary since this increases their tax liability. There's a valuable tax relief available, and this is called disallowed retirement annuity contributions. Andre and Susan have both made non-deductible contributions, which is also called disallowed contributions over the years. These can be withdrawn either as a tax-free lump sum or as a tax-free income until the disallowed contributions has been depleted. Next, we look at withdrawing income from discretionary investments and tax-free savings accounts. When it comes to withdrawing income from an investment plan, there's capital gains. This capital gains applies when assets are sold for a profit. Each individual has a 40,000 Rand annual CGT exemption. Only 40% of the gains is taxed, and the maximum marginal rate is about 18%. Dividends are subject to 20% withholding tax deducted automatically, and interest is taxed at your marginal tax rate. Under the age of 65, you get a 23,800 Rand exemption, but for persons over the age of 65, there's a 34,500 Rand exemption. Next, we look at withdrawing a portion of your income from a tax-free savings account. All withdrawals, capital, interest, and dividends are completely tax-free. Tax-free savings accounts are ideal for flexible, low-tax income during retirement. Next, we look at withdrawing a portion of your retirement income as rental income. Their Flat and Stellenbosch continues to generate rental income. This income will be taxed at Susan's marginal tax rate. However, they can deduct certain property expenses like levies, interest, and other expenses on the bond that will reduce their taxable portion. This creates a stable, inflation-linked income stream for the rest of their retirement years. We will then also advise them to draw a portion of their monthly income needs from their offshore endowment. Andre has invested his $110,000, approximately 2 million Rand, from his offshore bank account into his offshore endowment. Furthermore, he also invested the 1.2 million Rand annually from his salary into an offshore endowment. This structure defers income tax and gives you roll-up growth, which is then taxed at a flat rate of 12% currently for capital gains and interest. This is lower than Andre's marginal tax rate, which is currently sitting at 45%. So there's a massive tax saving. Why does this work? Offshore endowments become a powerful tax-optimized income stream during retirement by combining the following income sources wisely. Firstly, by drawing tax-free lump sums, tax-optimized living annuity drawdowns, tax-free and CGT-efficient discretionary withdrawals, roll-up endowment withdrawals, rental income after the expenses have been deducted, and withdrawing income from tax-free savings accounts. The result is significantly lower average tax rates in retirement, saving millions of rands over time. Capital is preserved longer since you can withdraw less income to get after-tax funds in your pocket, and you've got multiple income buckets where you can tap into when needed. It also provides you with more control about when and where you draw your income from. This approach helps reduce the overall tax burden and ensures sustainable retirement income. For clients with multiple income streams, our in-house accountants and tax specialists create tailored strategies that maximize tax efficiency while meeting individual financial goals. Now we need to look at what risks could derail their plan and how can Andre and Susan protect themselves against life's unforeseen curveballs. As retirement approaches, one of the most important questions is not just about how much do we have, but rather how do we protect what we've built up over the years. Even with 25 million Rand in today's money saved by the age of 60, Andre and Susan are not immune to the risks that can derail even the most carefully laid plans. Let's explore the key risks and how smart planning can manage and even mitigate these risks. The first risk we're going to look at is sequence of returns risk. Imagine Andre and Susan retire at the age of 60 with 25 million Rand. They plan to withdraw an income of 100,000 Rand per month. But what happens if the market drops by, let's say, 14% in the first year of retirement? If they withdraw 6% from for their living expenses and the market drops by 14%, their portfolio effectively shrinks by 20% in that year, leaving them with just 20 million Rand left. Now, to continue drawing the same income, they need to withdraw a higher percentage of a smaller pot, which puts their entire plan at risk. This is called the sequence of returns risk, and it's the most dangerous in the early years of retirement. The solution? A bucket strategy. So we manage the risk through segmented buckets. For instance, for the short-term bucket, let's say directly after retirement for the first 2 years, we'll put the investment in cash and near cash instruments. This ensures that Andre and Susan never have to withdraw from growth assets during a downturn. Then we'll have a medium-term bucket, the next 3 to 7 years. They will invest in bonds and income funds and low volatility investments. This provides stability and income while allowing the growth assets time to recover. And then we'll have a dedicated long-term bucket. This is for investments of 7 years and longer. Here we'll invest in equities, offshore investments, and growth-orientated investments. These ride out volatility and deliver inflation-beating returns over time. This gives them time for long-term assets to recover during market downturns without needing to sell at a loss. The next risk we need to address is the death of a spouse. This is one of the most overlooked risks in retirement planning. If one spouse passes away early, the surviving spouse may face a situation where the surviving spouse could move into a higher tax bracket, or the loss of one income stream, especially if both were drawing annuities. That could also lead to emotional and financial pressure during a very difficult time. The solution? Ensure joint ownership of discretionary investments where possible. Nominate beneficiaries on your annuities and life products. Consider life cover to bridge the gap. And structure your income so that if one income stream disappears, the others will be unaffected by the spouse's death. The next risk we need to address is long-term care and healthcare costs. Medical expenses in South Africa rise by approximately 10 to 12% annually. And by the age of 80, Andre and Susan may require home care, assisted living, or ongoing treatment. The solution? As part of our planning process, we've got a built-in healthcare budget. For Andre and Susan, that's 20,000 Rand per month, escalating at 12%. We keep this part of the portfolio and we make sure it's liquid and flexible for unexpected events. The fourth risk we need to address is inflation and currency erosion. With a heavy reliance on the rand, local inflation, especially in healthcare, can eat away the purchasing power of your funds. The solution? Diversification. Offshore investments help to preserve buying power in hard currency. An offshore endowment structure can provide access to American dollar, pound, and euro returns. Sectors like healthcare and infrastructure typically outpace inflation over time. This brings us to our last question. Can an advisor actually help them reach their goals? And can an advisor actually add real value to their portfolio over time? So let's bring it all together by circling back to Andre and Susan's example and running their plan through our retirement planning software. So if we do a recap of their situation, remember we said we had 3 different growth scenarios, 8% or moderate growth, a 10% moderate aggressive growth, and a 12% aggressive growth scenario. We can see clearly that at an 8% rate of return, considering all the implementation changes we made to their portfolio, now they're sitting in a situation where their retirement is roughly 86% funded. This is much better than 23% it was initially. If we look at a 10% growth scenario and taking all the considerations into account, then they're looking at 125% funded. This means that they probably have more than enough funds to retire comfortably, taking into consideration the income needs that we looked at earlier. And then if we look at a scenario where they get aggressive growth rate of 12%, this means their retirement is 178% funded, which means that they can retire comfortably. So what does this mean? This means by implementing effective tax strategies and investing in the right vehicles with the right asset allocation and risk profile, they can potentially reach their dream goals and have a carefree retirement. But here's the key insight. These projections aren't static. They evolved based on real-world decisions, market performance, and spending behavior. So let's look at real-world advice in action. Let's say you retire at the age of 60. At our review meeting, we will assess portfolio performance, economic conditions, and your actual lifestyle spending. You will also have digital access to your plan, and we track it together. If, for example, your portfolio grows 30 to 40% in the first couple of years after retirement, we may suggest taking profits from your equities, reducing your drawdown from your annuity, or delaying taxable income withdrawals for longer-term benefit. Real-world retirement planning is never a one-size-fits-all solution. It's a living, breathing strategy, and advice makes it work. Why it matters? The value of advice should be both quantifiable and emotional. For some investors, the value of working with an advisor is simply peace of mind, knowing they have a trusted partner navigating them through market noise, economic uncertainty, and life changes. While the emotional benefit doesn't easily show up in a spreadsheet, it's very real, and often the reason investors stick to their plan during difficult times. But beyond peace of mind, A growing body of research has shown that professional financial advisors and professional financial advice can add a tangible value to your portfolio returns. A 15-year study conducted by Vanguard found that following a structured wealth management approach, particularly for taxable investors, can add up to 3% in net annual returns through the following levers. This isn't 3% every year, but rather a cumulative effect over time, with much of the value realized during moments of uncertainty where poor decisions can derail your plans. So, where does the value of proper advice come from? Well, first of all, we look at behavioral coaching. Markets go up and markets go down, but it's what you do during those moments that determine long-term success. We help our clients avoid panic selling when the markets are down or chasing that hot investment return during bull markets. We also make sure that they don't abandon their plan based on a fear, media noise, or emotion. For Andre and Susan, this could mean staying invested during a volatile year instead of derailing their long-term strategy and locking in losses. This could also mean not investing a large portion of their portfolio or their life savings in the next Bitcoin scam. The second benefit is tax-efficient asset location. Where you place your investments matters just as much as what you invest in. By allocating assets between taxable, tax-deferred, and tax-free accounts, we minimize unnecessary tax drag. For example, place tax-efficient ETFs in a discretionary account or hold income-generating assets like bonds and retirement annuity. We can also use offshore endowments to convert income to capital gains, taxed at a flat 12%. For Andre and Susan, this means lower annual tax on interest and dividends, higher after-tax growth, and compound benefits over time. The third value add is tax-efficient withdrawal strategies. In retirement, it's not just about what you withdraw, it's how and when. We help clients like Andre and Susan withdraw in the most tax-efficient order, avoid triggering unnecessary taxes or moving into higher tax brackets, use disallowed retirement annuity contributions and tax-free savings accounts to draw tax-free income, and combine capital gains harvesting, rental income deductions, and offshore endowment income. The result? A more sustainable income stream of hundreds and hundreds of thousands of rands in savings and tax over time. The fourth value add is cost-effective implementation. The math is simple. Gross return, less fees, less taxes give you net return. Every unnecessary fee paid is a rand loss to compounding. That's why we focus on investing in quality low-cost funds for our clients, family fee aggregation on platforms, or aggregating offshore and local assets to save administration fees, and the combination of passive and active funds for the best blend optimization. In Andre and Susan's case, just a 1% fee and cost reduction on their 10 million rand portfolio equates to a saving of 100,000 rand per year. That's money that stays invested for the long term. The fifth value add is a proactive rebalancing strategy. As portfolios grow, they naturally drift from the original allocation. Without rebalancing, clients may become overexposed to risk, especially if they're invested in equities near retirement. We help by rebalancing and systematically making adjustments to portfolios, not emotionally. We maintain a risk alignment. We lock in gains by selling high and reinvesting low where possible. For Andre and Susan, this means selling a portion of the equities after a strong run, reallocating to bonds or endowments, and reducing the volatility in their portfolio and protecting the downside by properly diversifying their portfolio. For example, this could impact Andre and Susan the following way. Let's imagine Andre and Susan are 2 years into retirement. Their offshore portfolio had a strong run and is now overweight in global equities. Instead of riding the wave and panicking during the next downturn, we guide them. We take profits when markets are strong and we reduce drawdowns from their living annuity. These small adjustments, grounded in data and not emotions, can add years of sustainability to their plan. Let's wrap this up. This has been a long video with a lot of information to digest. But retiring in South Africa takes more than just saving. It takes smart, tax-efficient planning, disciplined investing, and continuous course correction as your life unfolds. If there's one thing Andre and Susan's journey shows us, it's this. The right plan and the right partner can make the difference between just getting by and truly thriving in retirement. And you don't have to figure it out alone. At Family Wealth Custodians, we work with South Africans every day to build plans that are not only financially sound, but emotionally reassuring too. If you're approaching retirement and wondering, are we on track? Let's talk. Hit subscribe, like this video, and share it with someone starting their retirement journey. Thanks for watching. We'll see you in the next video. And remember, keep on investing into your future.